Canada is sitting on a fortune, literally, trillions of dollars worth of oil. But here's the twist. What was once a golden ticket might now be a ticking time bomb. Environmental pressure, global energy shifts, and economic risk are converging to threaten Canada's oil empire. Today, we uncover why this trillion-dollar resource might be more of a curse than a blessing, and what it means for the future of one of the world's wealthiest countries. Canada is the fourth largest oil producer on Earth, trailing only the United States, Saudi Arabia, and Russia. Its crown jewel is the Alberta oil sands. One of the largest oil reserves in the world, experts estimate that these sands hold over 170 billion barrels of recoverable oil, a sum worth trillions at today's prices. On paper, it seems like a dream come true. Enormous wealth, global influence, and a steady flow of high-paying jobs. But the reality is far more complicated. Extracting oil from sand is extremely expensive and environmentally damaging. Unlike conventional oil, oil sands production requires enormous amounts of water, energy, and chemicals. Every barrel comes with a hidden cost, one that Canada is starting to feel more acutely with each passing year. For decades, Canada's oil sector has fueled economic growth. Revenues from oil support not just Alberta, but also the federal government, funding healthcare, infrastructure, and social programs. For many Canadians, oil isn't just a business, it's a lifeline. But beneath this prosperity lies an uncomfortable truth. Cracks are appearing in Canada's oil empire, and they're growing fast. One of the biggest challenges is environmental pressure. Oil sands are among the most carbon-intensive sources of oil in the world. Producing a single barrel can emit up to 3 times more carbon dioxide than conventional crude oil. As the world races to curb greenhouse gas emissions, Canada's oil industry is increasingly under scrutiny. International agreements like the Paris Accord have placed heavy pressure on countries to reduce their carbon footprint, and investors are responding. Major banks and pension funds have begun avoiding oil sands projects, labeling them too risky. The message is clear. High-carbon oil may no longer be welcome in global markets. Resistance is not just external. Within Canada, Indigenous groups, environmental organizations, and citizens are increasingly pushing back against pipeline expansions and oil projects. Legal battles over pipelines like the Trans Mountain expansion drag on for years, raising costs and creating uncertainty. Every protest, lawsuit, and delay chips away at the profitability of Canada's oil, making investors hesitant and slowing growth. The economic risks are striking, despite the trillions of dollars supposedly on the line. Extracting oil sands is costly. Advanced machinery, massive energy inputs, and water treatment facilities all drive up the price of production. When global oil prices fall, entire projects can become unprofitable almost overnight. Meanwhile, the world is slowly shifting toward renewable energy and electric vehicles. If demand for fossil fuels drops faster than expected, much of Canada's oil could remain underground, turning trillions in value into stranded, worthless assets. Currency fluctuations and market volatility add another layer of risk. Oil heavily influences the Canadian dollar. A collapse in prices could ripple through housing, banking, and government budgets, threatening the broader economy. The challenge extends beyond economics. Canada's oil depends on pipelines and other infrastructure to reach global markets, but these projects face constant delays and controversies. The Keystone XL pipeline, once a cornerstone for transporting Alberta's oil to the U.S., was cancelled after years of legal battles and political pressure. Each delay not only raises costs, but also leaves oil sitting idle, creating financial and logistical headaches. Meanwhile, public opinion is shifting. Younger Canadians in particular are increasingly concerned about climate change and less supportive of fossil fuel expansion. Politicians are caught between the demands of the economy and the climate. Trying to balance jobs with sustainability a nearly impossible task, Canada is not alone in this dilemma. Oil-rich countries around the world are grappling with the energy transition, but Canada's situation is particularly precarious because most of its reserves are high-cost, high-carbon oil sands. Unlike cheaper Middle Eastern oil, Canadian crude is vulnerable in a world moving toward low-carbon energy. Analysts warn that if global climate targets are met, a large portion of Canada's oil could become stranded assets, resources too expensive or environmentally unacceptable to develop. The financial consequences of this could be staggering, potentially triggering shocks similar to past economic crises, but concentrated in natural resources. Some in the industry argue that technology can solve the problem. Carbon capture, more efficient extraction methods, and emissions reduction are presented as solutions. But critics are skeptical. These technologies are expensive, untested at large scale, and slow to implement. Others suggest diversifying the Canadian economy away from oil dependency entirely, investing in renewable energy, technology, and green infrastructure. The challenge is that the transition would be politically charged, economically difficult, and socially disruptive. Canada is still heavily tied to oil, which makes the shift painful and slow. For investors, the message is sobering. Canada's oil might look like a safe trillion-dollar bet, but the reality is far riskier. What seems like a fortune on paper could easily turn into a liability if global demand for high-carbon oil collapses or costs rise unexpectedly. For ordinary Canadians, the stakes are equally high. Oil supports jobs, government revenue, and local economies. Yet climate change, economic volatility, and global energy shifts could turn this asset into a problem almost overnight. Canada faces a difficult choice. It can continue to double down on oil, hoping the world won't move fast enough to leave it behind, or it can rethink its economy before the next crisis hits. Each path comes with trade-offs, risks, and consequences that will affect generations to come. The question is no longer whether Canada can afford to rely on oil, it's whether the world will allow it to. In the next chapter, we'll explore how the global energy transition is already eating away at Canada's oil dominance and why trillions of dollars it could vanish faster than anyone anticipates. The end of an era might be closer than most people realize. Imagine a world where the oil that Canada has spent decades digging out of the ground suddenly becomes a burden rather than a blessing. That world isn't far away, it's already starting to arrive. Around the globe, countries are racing to cut carbon emissions, switch to renewable energy, and phase out fossil fuels. And in this new reality, Canada's massive oil reserves face a question that no amount of drilling or pipelines can answer. Will anyone still want them in 10, 20, or 30 years? The energy transition isn't a distant trend. It's happening right now. Electric vehicle sales are surging, with countries like Norway, China, and even parts of the United States committing to fully electric car fleets within the next 2 decades. The International Energy Agency predicts that by 2030, global demand for oil could plateau or even decline, driven by EV adoption, improved energy efficiency, stricter climate policies. For Canada, whose oil sands are among the most carbon-intensive in the world, this is a massive problem. Unlike light crude from the Middle East, Alberta's oil is expensive to extract, highly polluting, and increasingly unwelcome on international markets. Investors are noticing. Pension funds, sovereign wealth funds, and major banks are increasingly wary of putting money into oil sands projects. The logic is simple. Stranded assets are real, and the risk is enormous. Once investors start pulling out, projects slow or stop, and companies face skyrocketing costs. Already, several large-scale developments have been paused or abandoned because the financial risk became too high. The era when trillions of dollars could be printed from Canadian oil may already be fading. Meanwhile, governments around the world are tightening emissions regulations. Europe, a major buyer of crude, is implementing stricter rules on carbon content, making high-emission oil less attractive. The United States, Canada's largest trading partner, is also pushing renewable energy policies and stricter environmental standards. Even countries that are traditionally heavy oil consumers are signaling that the fossil fuel age is drawing to a close. For Canada, this means the oil that has fueled decades of economic growth could face shrinking markets just when production costs are peaking. Technology adds another layer of disruption. Solar and wind are no longer niche energy sources. They are now cheaper than fossil fuels in many regions. Battery storage is improving rapidly, making renewable energy reliable at scale. Electric vehicles are no longer futuristic, they are mainstream. Every solar panel installed, every EV sold, chips away at the global demand for oil. The world isn't waiting for Canada to catch up, it's moving ahead, leaving high-cost producers like Alberta struggling to compete. Canada's oil is trapped between 2 massive pressures: global markets moving away from fossil fuels and domestic infrastructure challenges that limit expansion. Pipelines, rail transport, and port facilities are already at capacity. Building new infrastructure is expensive, politically contentious, and often blocked by environmental regulations or public protests. Even if Canada wanted to ramp up production to capture every last dollar of oil, it simply couldn't do so efficiently. The financial implications are staggering. Analysts warn that trillions of dollars in potential oil revenue could evaporate if demand drops faster than expected. Companies could be left with massive unused reserves that are impossible to sell at a profit. Provinces like Alberta, which rely heavily on oil revenue for public services and jobs, could face a fiscal crisis. Governments across Canada may need to rethink budgets, taxes, and social programs if the oil boom fades faster than anticipated. Even the social impact cannot be ignored. Communities built around oil production are deeply invested in the industry. Jobs, schools, infrastructure, and local economies depend on the flow of oil money. If the world transitions too quickly, these communities could face severe disruption. The human cost of stranded oil is just as real as the financial one. Politicians, industry leaders, and ordinary Canadians are now forced to grapple with a hard truth. The oil era is not eternal. Some argue that carbon capture technology and other innovations could save the day. If emissions can be reduced and production made more environmentally friendly, Canadian oil might survive the transition. Yet these technologies are expensive, untested at scale, and slow to implement. There's no guarantee they will arrive in time to prevent a market collapse. Meanwhile, renewable alternatives are advancing at breakneck speed, and each passing year strengthens the competition. Another factor accelerating the crisis is investor sentiment. Global capital is moving rapidly toward green energy, according to recent reports. Billions of dollars are leaving fossil fuels each year, redirected toward solar, wind, electric vehicles, and energy storage. High-carbon oil projects are increasingly seen as financial risks. For Canada, this means even if oil demand exists, securing funding to extract it is becoming harder, raising production costs, and potentially leaving valuable reserves untapped. Climate activism also plays a critical role. Public opinion is shifting, and governments are feeling pressure to act. Legal challenges, protests, and social campaigns have already delayed major pipeline projects and increased operational costs for oil companies. Environmental accountability is no longer optional. It's a requirement for market survival. In this context, every barrel of oil produced comes with a risk that extends far beyond the drilling site. Canada's predicament highlights a global paradox. Oil, once the ultimate source of wealth and power, is now increasingly a liability. Countries that relied on fossil fuels for decades are forced to pivot, while high-cost producers face the harshest consequences. For Alberta, the implications are profound. Trillions of dollars on paper could translate into financial instability if global energy trends continue. The oil that was once considered the backbone of the Canadian economy may now be one of its greatest risks. The situation is complicated further by uncertainty over global politics. Trade disputes, carbon tariffs, and energy sanctions could suddenly make Canadian oil less competitive. Any disruption in international markets could magnify the already existing challenges, turning what seems like a stable revenue source into a volatile gamble. Investors and governments alike must contend with a future where oil demand is shrinking and competition from renewables is intensifying. For ordinary Canadians, the energy transition carries both opportunity and risk. On one hand, renewable energy development could create new jobs, industries, and a more sustainable economy. On the other hand, communities tied to oil production face a precarious future. Education, tea raining, and economic diversification are now urgent priorities. The challenge is enormous. Replace a $1 trillion industry without leaving behind the people and regions that built it. As we look ahead, it becomes clear that the global energy transition is not a distant threat. It's an immediate reality reshaping markets, politics, and societies. Canada's oil sands, once a symbol of unending prosperity, are now caught in a perfect storm of environmental, financial, and social pressures. The end of the oil era may not happen overnight, but the writing is already on the wall. Every investment, pipeline, and barrel of oil extracted today is subject to uncertainty that previous generations could never have imagined. The stakes couldn't be higher. Trillions of dollars are at risk. Communities hang in the balance, and Canada must decide whether to cling to the past or embrace a future less reliant on fossil fuels. The choices made in the next decade could define the country's economic and environmental legacy for generations to come. In the next chapter, we'll examine the human and economic consequences in even greater detail, exploring how governments, companies, and everyday Canadians are preparing or failing to prepare for a world where the trillion-dollar oil fortune might no longer exist.